Very good. So, hello, good evening, good morning for some of you. Thank you for coming to this webinar with a very interesting title and subject these days, Maintaining Finance for Firms Impacted by COVID-19, Perspectives for East Asia. It is a pleasure for me to do the opening remarks of this seminar and to moderate the Q&A after hearing for the four speakers, great speakers that we have today. My name is Alfonso Garcia Mora, and I am the Global Director for Finance at the World Bank Group. And this is a topic that we have been working for a long time, actually for the last weeks very intensively at the bank, trying to understand what are the best ways that policymakers and authorities can help firms to remain alive in this very tough and difficult context. I think that the presentations that we will see today are excellent, all of them, very complementary one to the other, and will help us to answer some of the questions that we might have these days. First of all, the need to support firms. There was a debate at the beginning of the crisis if policymakers should be focused on supporting households or supporting firms. Why it's actually relevant to support firms, given that at the end of the day, what matters is the household and the livelihoods. A second point that will also be good to hear, we will hear from speakers, is how this support should take place. What are the instruments that we should use to support firms, if it is through regulatory measures, regulatory forbearance, for instance, or any other regulatory relief measures, if what we need is liquidity, or if what we need is equity. I mean, what are the instruments that we should put on the table to support firms these days? A second topic is which are the firms that we should target? Should this support to firms go to all the landscape of firms that exist in countries, like many advanced economies have already done? Or should we do a much more targeted approach based on different factors and different policy objectives, which is particularly relevant in emerging markets and developing economies, because we know that the fiscal space is much more limited than in advanced economies, and therefore the capacity to influence or to support all the firms is much more limited. And the third one is for how long, which is also an important question, because we know that one of the most difficult things of this crisis is to understand how long this is going to take to really come back to a normal situation. And therefore, any measure that we introduce today, even if it is extraordinary and needs to be time-bound, it is not so easy to understand what is the sunset, where the sunset clause should be, and where the time-bound should be put. So all these are questions that we would hear from many of the topics that we would hear from colleagues, from the presenters, which at the end of the day take us to the, I would say, one of the big questions when thinking on maintaining firms alive, which is to what extent can we, or are we able to differentiate between firms' survival versus perpetuating zombies down the road? And to what extent we are really helping the productive sector to remain alive with all the important benefits that it has in terms of employment, etc., versus creating problems in terms of moral hazard or in terms of deterioration of assets for the financial sector down the road. So I'm not going to take more time. I just wanted to do a very brief introduction because we have, as I said, very good presentations, and I will come back actually with some specific questions at the end of the presentations, because I found all of them. One of them I already knew, but the other three is super interesting and very attractive from an intellectual and policy perspective. So we have Ilhyock Shim, Head of Economics and Financial Markets for Asia and the Pacific, Monetary and Economic Department from the BIS, Bank for International Settlements. We have also Sergio Schmukler, Lead Economist and Acting Research Manager of the Development Research Group at the World Bank Group. We have Huang, who is Associate Professor of International Economics at the Graduate Institute in Geneva. And we have Joseph Cherian, who is practice professor of finance at the National University of Singapore. So a very good set of policy makers or standard-setting bodies very close to policymakers, World Bank, and academics to discuss this fascinating topic. So let's start, and maybe we can start with Ilhyock Shim with his the first presentation on capital flows to emerging markets and corporate sector liquidity. Ilhyock, the floor is yours. Thank you.
Okay, thank you. First of all, I'd like to thank Sergio Schmukler and webinar organizers for inviting me to this webinar. So before I start, let me mention that this usual disclaimer applies. So the views in this presentation is my own, not necessarily the views of the BIS. Okay, so my presentation will have three parts. The first one, I'm going to give you a sort of overview of the portfolio flows to EME during the COVID-19 pandemic. The second part will focus on something called original stream redux, which the BIS has been emphasizing recently in the context of COVID-19. And then the last part will focus more on the corporate sector liquidity issue during the COVID-19 based on a BIS bulletin article that came out last month. So the first chart you see here basically compares the global financial crisis, potential, and COVID-19 in terms of the EM portfolio flow and exchange rate. Here I show you the two types of portfolio flows, equity and bonds, measured by the IIF, which is the BOP type flow, and then EPFR bonds fund flow. And if you look at the right-hand panel for COVID-19, you can clearly see the size of outflows from EME this time was quite large, about $100 billion based on the IIF data. And substantial part of that, the blue line, is explained by the EME bond and equity fund flows. And what's noticeable here is about 8% depreciation of the EME currency happening at the same time. I'll come back to this point later when I talk about original stream redux. And what's actually quite different this time compared to the previous episode is the relationship between the EME bond fund flows and advanced economy bond fund flows. So what normally happened in the past, when there was a EME bond fund outflow, and advanced economy bond funds often had inflows, some sort of substitution. So what you see this time, if you look at the left-hand side, both the EME bond fund flows and advanced economy bond fund flow have a huge amount of outflows. But the one side, it's not looking at the dollar value, really doesn't give us a very accurate picture because this kind of bond flow, bond fund database, they have been developed over a long time. The early part, like 2005, 6, 7, the coverage of the bond fund was not that good. And also, we all know that the bond market in EME, also advanced economy, has grown very fast. So just looking at the dollar amount, it's probably not very good. So if you look at the right-hand side panel, up and down, this one says normalized by the total net assets, all bond funds, advanced economy in EME. And you can see that the size of the peak, the more recent one, is comparable to GFC type peak for the EME bond fund. Actually, the advanced economy bond fund, this time the peak was much sharper. To give you a bit more sort of a standardized comparison, I define a severe redemption episode like the following. So episode starts when the outflows to total net assets of all bond funds surpass 1%, relatively large outflow within a week. And then the outflow, severe outflow, continues at least 2 weeks or more. outflow per week. And then that episode ends when the outflow falls below 1%. The main idea in this sort of a definition is typically the EM bond funds, they have about 5% cash compared to the total net assets. If you face this type of very severe outflow for 2 or 3, 4 weeks, then you basically end up putting all your cash in the fund and start selling your bonds. So this is sort of a stress to the bond fund so that they have to start selling actively the bonds they're holding. So we are thinking about that as a sort of severe redemption episode. And we can identify from the data for 4 episodes, GFC, European sovereign debt crisis, hypertension, and COVID-19. And if you compare the GFC and COVID-19, GFC had longer duration, bit sharper peak in terms of outflow, but they both have very similar average weekly redemption. So intensity-wise, they're very comparable. But the COVID-19 was much shorter in the GFC. Now we can think about the components of the bond flow. So which asset class, which type of bond funds were driving a severe redemption episode. If you look at the upper left panel, the red line shows local currency bond funds, mostly government bond funds, and they were driving outflows during the GFC. If you look at the lower right-hand panel for COVID-19, you can see the red dotted line, which is the local currency corporate bond fund, which was leading the redemption episode this time. So over time, we have seen the corporate bond funds have actually increased in size a lot. And by now, large redemptions on local currency corporate bond funds was a very important factor in driving redemption. So far, everything was at the aggregate level. And you can also think about the fund by fund, what was the redemption episode and how severe was it. So now you are talking about the more recent few months episode. And if you look at the March 2020, this is weekly flows. So the last 4 column bars in each chart. So during the peak of the redemption in March, you see about 80% of funds in each asset class, especially the ones at the top, which are less liquid asset funds. They had about 80% was facing redemption. If you look at the dollar amount, comparing the inflow and outflow, on the right-hand side, you can see that at the peak it was predominantly outflows. What we see in those aggregate numbers is the sum of the inflows and outflows. If you actually decompose that, you can see that the fund investors in EM bond funds, either corporate or government bond funds, they tend to herd, more like herd, meaning they tend to run at the same time to many, many funds. So that's actually the reason that we are seeing this huge amount of sharp redemption or spike. And this is not the first time. We see similar spikes at the hypertension and the global financial crisis. If you look at the lower 3 asset classes like EM, advanced economy bond funds, or EM equity funds, or advanced economy equity funds, actually we don't see that much imbalance between inflow and outflow in terms of number of funds or in terms of dollar amount. So the whole chart basically shows that the underlying asset liquidity actually matters a lot in terms of the run dynamics. And we can see the same thing in terms of how many funds actually face very large redemption on a weekly basis. If you look at the left-hand side, we are counting 1% outflow in each week. And you see that the less liquid asset class funds, such as EM corporate bond funds and EM common bond funds, about 40% of funds are facing outflows, severe outflows 1% or more. The right-hand side panel actually shows 5% or more outflow, which is extremely large. So you are wiping up all your cash within 1 week, basically. And still about 15% of funds were facing huge amount of outflow in 1 week. And you can compare that peak for the lower panel more liquid ones like advanced economy bond funds or equity funds, and the peak was much lower, about 20% on the left-hand side and 5% on the right-hand side. So this one again shows the importance of the investor sort of behavior in terms of one dynamics, depending on the asset class. Okay, now I'm moving to the second part of my presentation about original swing redux. So after the 1997-8 Asian financial crisis, and this whole idea of original sin heavily affected the policymakers in the region. And one direction or one dimension all policymakers tried very hard to develop local currency bond. At the same time, as local currency bond market developed, many foreign investors decided to come in and invest in local currency bonds. And what we observed this time, and also over the past 10 years or so, is that even though those E&E governments are borrowing in domestic currency, they are local currency bond markets, they are not actually insulated from the currency movement. That's mainly because we have seen, as you see in the chart, exchange rate movement, depreciation, and the bond spread going up at the same time, and also the bond outflows. So the main reason is the foreign lenders' point of view, they borrowing local currency. So the borrower point of view, for example, EM government or EM corporates, they are not subject to any currency risk. They are borrowing local currency. But the lenders, in their balance sheet, their liabilities are mostly US dollar or other kind of currency, and they're investing in EM bonds. So there is currency mismatch still in the balance sheet. So that's something the Augustine Carson and Samson Chin calls original swing redux. So let me just show you a few more slides to explain that point. So this chart basically shows that the foreign ownership in the local currency sovereign bond market, EMEs, increased steadily over the past 10 years or so. And the right-hand panel basically shows that if you sort of sort those countries further than in terms of the level of foreign holdings at the end of last year, and then see what happened over the first 2-3 months this year during the COVID-19 pandemic, and you can see positive relationships, meaning the countries which had higher levels of foreign holdings in the local currency market, they actually experienced a higher increase in the local currency bond spread this time. In the next chart, it's basically suppose you are the dollar-based global investor investing in EM bonds, and you are looking at two different kinds of returns. The US dollar return, which actually has two components. One is local currency return and FX return. So you are basically investing in local currency and bonds. So you can decompose the two returns, FX and local currency bond return. And the chart here basically shows that those two returns, they tend to move in the same direction. So let me just give you an example on the upper left-hand panel. Pre-COVID-19 period, EME for flow investors, EM bond yield goes down. Moving to the left, the blue line basically shows the local currency return. Yield goes down, bond price goes up. At the same time, EM currency appreciates. So you have higher return. The red one is higher than the blue one. And the same goes in the opposite direction. And the EM bond yield goes up, bond price goes down, and also EM currency depreciates. So from foreign investor point of view, you are having a more sensitive return, steeper red line, which is what we can think about as a duration. So higher duration for the US dollar return context than the local currency. And that was the same in the COVID-19 period, which is upper right-hand panel. And you can see the same thing for the advanced economy. So before COVID-19, actually, when advanced economy point of view, here we use data from Canada, France, and Sweden, and their own local currency bond price went up. Actually, their currency depreciated. So there was sort of a cancellation going on. But what's interesting is this time COVID-19, advanced economy was basically behaving as almost same as the EMEs. When the local currency bond prices went down, it went up, and their currency actually depreciated. So it was quite rare, but this actually happened this time. So that's something we can point out. Problem with, okay, there we go. So then question is, what is all witnessing whether tell us in terms of the policy framework or for central bank point of view? Many of you have seen that BIS and also other international organizations, we have emphasized something called integrated policy frameworks. So from EM point of view, exchange rate volatility, capital flow is a big challenge, and they have been using many different policy tools, monetary, macroprudential, or sometimes even FX intervention to deal with such challenges. And then this time, COVID-19 pandemic is actually the BIS feel this is a very big stress test for EM policy framework. Because so far, until last year, major policy dimension was large inflows and how you deal with that. And now this time we have seen large outflows. And again, many different policy tools have been used and expected to be used. So those policy frameworks using different policy mix have been quite effective in containing inflation and also dealing with the financial excess through the macro-potential and FX reserves. But then this time, because the bond market was moving together with FX, the idea of government playing the role of the dealer or buyer of last resort came up. And already many central banks in EME, such as Colombia, Indonesia, the Philippines, Poland, South Africa, they have launched bond purchase programs, and Bank of Thailand also introduced a mutual fund, stabilization fund. So they actually introduced some facilities to stabilize the bond price itself, in addition to stabilizing the FX through the FX reserve.
Ilhyock, we need you to please finalize quickly.
Yes.
Yeah.
So just quickly go through the corporate sector liquidity issue. We all know that current crisis has had a huge impact on the corporate in terms of their cash and revenue. So the BIS, bulletin number 10, had a quick exercise. They used about 40,000 data from Capital IQ in 26 countries. So what they looked at is they compared cash versus debt service. And here on the left-hand side chart, you can see that many EMEs, actually, they compare the both. A lot of companies are actually facing trouble in terms of meeting using the cash is not enough to make the debt service ratio. Then naturally, those firms can rely on the credit line from banks. And indeed, many countries' firms do have large amount of credit lines, and that's good. But then also many EMEs, we see the credit lines are not enough to cover the debt service. And then, of course, we have a lot of decrease in some revenues, often more than their cost. So that means they have to borrow more to fill the gap. And then this chart basically shows that the funding gap, which is comparing the total expenses, interest payment, their cash and other income. And you can see that many EMEs are likely to face more than 10 percentage point increase in their leverage ratio if they have to meet those funding gaps over the coming year. This is another scenario of 25% revenue going down, and the sensitivity of cost and revenue, let's say, is about 0.6. This is a simulation. Then let me just quickly point out that there can be many different policy tools to deal with these challenges, such as bridging loans, subsidy firms, other sectors, even government can provide some sort of guarantee for credit enhancement. So especially important thing that the BI has been looking at is the trade credit. Trade credit is a very important one, and we have seen a lot of disruptions in the trade value chain. A lot of actions can be taken in that. Let me stop here. Thank you.
Excellent. Thank you very much, Ilhyock. Very interesting presentation with a very interesting actually data and graphs and very good food for thought for the discussion afterwards. So thank you. Now we move to Sergio Schmukler from the World Bank. Sergio, the floor is yours. Thank you very much, and please do not take more than 15 minutes so that we can have enough time for the Q&A. Thank you, Sergio.
Thank you very much, Alfonso, and thank you, Reka in Malaysia, for encouraging us to write this work and prepare the workshop and helping us put together the workshop too. It's a pleasure to be here. Today, I want to present a research brief that we did for the Malaysia Hub. And this research and policy brief is called Firm Financing in Hibernation during the COVID-19 pandemic. And it's joint work that we have been doing with Tatiana Didier, Federico Juneus, and Mauricio Larraín. Tatiana is also at the bank in Alfonso's group. So by now, we know that as Ilhyock was mentioning, that the financial markets are in stress, both international financial markets and the domestic financial markets. And we all know that the COVID-19 pandemic has had a profound effect on firms. There is substantial heterogeneity across industries. Not all industries are being affected, and not all firms within industries are being affected. There are some firms that have completely shut down for a while. Others are doing fine, and other firms are in the middle. But there is a large mass of firms that are hurting. And the policy debate, as Alfonso was mentioning at the beginning, is this idea that we need to save firms from this big collapse in the real economy and also in financial markets, as Ilhyock was mentioning. And this is in addition to whatever measures we take to save households. There are many proposals to do this saving of firms. And what we do in this work is we present a unifying framework to try to organize the debate related to firm financing during the pandemic. We discuss what the policy options are, given the challenges that policymakers face, and also the trade-off what the policymakers are facing when trying to save firms. So basically, we make 4 related points in this policy brief that Norman helped us publish in the Malaysia Hub. And the 4 points that we make is, one is that this COVID-19 pandemic is generating a different type of crisis. This is a health crisis with economic effects. And this matters for the transmission channel of the crisis and for the resolution. And I will elaborate that in a second. The second point I want to make is that firms have important relationships with different stakeholders, and this pandemic is putting a lot of stress on those relationships. This is also a key point that I think is worth keeping in mind. The third point is that one way forward that some firms have been trying to work with is to hibernate. And we will distinguish what hibernate is, how this differs from the idea of freezing the economy. But in these instances, to hibernate, firms need credit. The fourth point that we want to make is that there is a lot of policy action on the financial side, as Ilhyock was mentioning, both for international financial markets, but also for domestic markets. One major issue to take into account is that the existing financial infrastructure is ill-equipped to handle the pandemic. And the crisis can make and if we let the financial infrastructure operate as in normal crisis, it could make this pandemic crisis worse. So therefore, policymakers need to innovate on the policy front to try to use a different type of tools that can help firms survive and cope with this shock. So in the typical crisis that we have observed in the past, they tended to originate in the financial sector, Banks or market participants were behaving irresponsibly, probably due to moral hazard. Were taking excessive risk that generated a liquidity problem. Banks or markets suffer a run, then they stop lending, and that shock transmitted to the real economy. That's the typical financial crisis. Here in this crisis, the root of the problem is outside the financial sector. It's a health issue that has generated a supply shock and the demand shock. As a consequence of the policy measures of locking down many economies and locking down international flow of people and to some extent tourism and businesses, and the cash flows have collapsed to unprecedented levels. So firms are struggling to survive in many countries, as Ilhyock was mentioning, and this also has the potential to affect the financial sector that might end up in trouble. So the days of cash in hand across industries shows that firms have between 30, 60, 90 days of cash to survive. So if the crisis continues for much longer, a lot of firms will basically don't have any cash to continue operating. We know that this crisis is a transitory health shock that eventually will get resolved. But in the meantime, if the crisis persists, the crisis persists, is generating a lot of credit risk problems. We know, and creditors know, that most industries as a whole will still exist later on. For example, airlines, restaurants will exist later on. But maybe not all firms within these industries will survive this lockdown or the pandemic in general. So banks face problems with the assets that they have. They don't know who to lend because they don't know which firm will survive. And if banks try to act upon this and stop lending, they might by themselves push firms into bankruptcy, in addition to the problems that firms are having because revenues have collapsed. Ryan, I think, okay, here. Okay. So what is important, if we push firms to bankruptcies, they will generate probably inefficient bankruptcies because firms were doing fine mostly before the crisis. If we start liquidating firms, firms will need to appear after the crisis. Firms usually have some key relationships with different stakeholders. They have to take in time to find the appropriate workers, train the workers. They have to find the appropriate suppliers, work with the suppliers. They have built loyalty programs or some long-term relationship with customers, with creditors, etc. So firms have all those set of relationships that are part of the intangible capital of firms, part of the organizational capital. They are very costly to build, maintain, and adjust. If we shut down firms and then start with new firms later on when the economy has recovered, we will need to rebuild all those relationships. That would be extremely costly. It will put more hysteresis effects in the economy. And the idea of trying to reigniting the economy after the pandemic will happen with a higher likelihood if firms are there to restart and resume the work when things improve, not if we shut down firms and we need to recreate firms. So the idea of the hibernation is the idea that firms might be able to operate at the minimum capacity if needed during this pandemic. And this idea of hibernation is different from the idea of freezing. In many articles, and even for some countries like Denmark, it has been proposed that the economy becomes frozen. So we freeze everything and then we resume later on. The problem is that we cannot freeze everything because the owners of the firms, the workers, they need to live throughout this period. Some minimum capital needs to be maintained. Think about airplanes. You need to, even if you're not operating the airplanes, you need to park them. You need to rotate the tires so they don't get damaged during the time that they are waiting to resume flying. So those things involve expenses. Those expenses the firms have to do no matter what. So some minimal expenses need to go through this period of hibernation, as if the idea of these the bears hibernating during the winter time. They still consume some energy, and to be able to consume that energy, to be able to kind of spend some cash, because firms are short of cash, they might need financing to survive through this period. And at the same time, the different stakeholders, the different relationships that they have, they will all take a hit. I mean, everybody, this is a negative shock. That is a negative shock that is going to be distributed among everybody. If we just push firms to take all the hit and borrow so they can maintain all their relationships, the debt burden might be unbearable later on. And we might be creating those zombie firms that many people are referring to. So the idea is that we minimize the expenses and we finance those expenses in this period so firms can survive. To do this, you need some new policy measures because the policies that are already in place are not going to work very well. Usually, the policies of the financial sector is if you have a problem, you identify what is wrong, you try to isolate that part that is wrong, you kind of remove the bad apples, usually because there are problems of moral hazard, you try to avoid contamination to the rest of the financial system, you resolve, and then you move on. And then the financial system continues operating. So the existing policy framework tends to punish firms or banks that are doing badly. At this point, everybody is doing badly. So identifying firms that are in bad shape is not useful because you're going to be penalizing the firms that you want to preserve for the future. So the idea is that the existing policy measure framework is not going to help us. So what are the policy initiatives that policymakers have been thinking about? There are different ones, and they can be divided in different buckets. One is adapting the institutional framework so we can deal with this pandemic shock. Another one is to provide credit to firms through providing either liquidity to intermediaries or providing direct credit by the government to firms. In terms of the adapting institutional framework, as Alfonso mentioned, one possibility is to generate forbearance, postponement of payments. But to do that, you might need to work with different branches of the government because the executive government cannot just do this. You might need to work with the judicial system or the Congress to pass new laws and new regulations to deal with these circumstances. It depends on the country, but it requires coordination. And this also usually poses a trade-off because if you do forbearance, postponement of payments, that can generate some kind of rapid assistance, but you are redistributing losses among different participants in the economy. You might be bailing out firms that ex ante were doing badly, so you might generate some type of moral hazard problem. And you might also generate problems ex post of moral hazard because you might be providing assistance of firms that later on will use the financing that we are providing to do things that we don't want and then not repay. So there is a trade-off there that we need to consider, but that's one set of policy, and the trade-off is something that just to keep in mind when implementing these type of policies. As I mentioned, the other type of policy that is possible is to provide credit to intermediaries. The problem is that if you provide credit to intermediaries, you can do it rapidly, but banks don't know who to lend to. So it's not clear that banks are going to on-lend that money, or the financial market will on-lend that money because of this credit risk that I mentioned. So the other possibility is to provide credit to firms directly by the government. One possibility is to do it through to SMEs, through the capitalization of state-owned banks or public credit guarantees, as Ilhyock mentioned. That's one type of policy. This generates access to credit directly to firms, but you are kind of expanding the government's balance sheet. The same thing with large firms. You can provide financing to large firms. They have other instruments. Again, you provide credit, but you are expanding the balance sheet of the government. One thing that has happening in China, which is we're looking at the data, if one looks at the amount raised in corporate bond markets, and the next presentation might deal with this issue in particular in China. But one thing that we have observed is that financing in March already kind of recovered. So large firms, they might benefit from assistance from the government, but at the same time, they have other instruments that the SMEs don't have. And one type of instrument is borrowing again in capital markets, to the extent that those markets, the domestic capital markets, are open already. Let me find out, I don't have much time to conclude. I think the governments, in kind of looking at the different policy options, they need to prioritize which policies might be better. It might fit them better according to the circumstances, and evaluate the trade-off. They need to decide between financing large firms versus SMEs. They might want to finance firms with different relationships that are difficult and very costly to build. They might want to finance firms that are in critical industries. They might want to condition the help on firms keeping those certain relationships. For example, in some countries, governments are financing firms with the condition that they keep the employees on their payroll. There could be also a trade-off in terms of allocating resources for the governments between the short run and the long run. The short run is the hibernation period versus the long run, when the economy goes back to normal. At that point, the advantage is banks will know, and the financial intermediaries will know which firms have survived. So it will be easier later on, but there might be extra financing needed at that stage. Another issue to consider is that initial conditions matter a lot, and there might be huge differences between developed and developing countries and among each group. And the very final point is that the pandemic and the lockdown of the economy usually generates an intergenerational transfer, in the sense that we are, in some sense, locking down the economy to protect the older generation that is more vulnerable, and we are preventing the young generation from going to work. These policies to save firms are not generating this type of intergenerational transfers, because they are kind of saving firms for the young that right now cannot work. So in that sense, there is something to keep in mind when looking at how we distribute losses, how we allocate these losses from this pandemic that everybody has to suffer. Thank you very much, and sorry for going a little bit over.
Thank you, Sergio. I think that we all feel excited with this topic, so we are all over the time limit, which is normal in these circumstances. But thank you very much. So, Huang, you have the floor. It's also actually with a presentation that complements very nicely one of the messages that Sergio was passing. So the floor is yours, Huang. Juan, we cannot hear you.
Ilhyock, yeah.
Yes. Okay. Thank you very much for the invitation. Good morning, and I'm very glad to present.
If you can talk closer to the mic, because it was not easy to hear those that are not close to the mic. Okay.
Very good. So I'm very glad to present this paper, joined with QG Chen from Fudan University and Doro Xia from BIS and Yaya Yu from SAFE and local academia. So this is a joint work where we try to, ongoing work, we try to understand how corporate bond market responds to the COVID-19 pandemic in China. So Dora, since Dora is working at BIS, she has normal, usual disclaimer about all the view from her, not from BIS. So let's start it. Okay, move the slides. Hello?
I've given you control right now. Are you able to move the slides? If not, I can move them for
Move
you.
the slides. Okay, please move for me. Thank you.
Sure.
Okay, so as we know, the COVID-19 started with at early December last year, and we have a very nice ongoing research how to summarize what's going on after pandemic outbreak, COVID-19 outbreak. So if you look at the blue line, which is the number of new confirmed in China case, and a very important phenomenon I will emphasize today is the reopening of capital market in China. So which leads to today's discussion, how corporate bond market responds to COVID-19 outbreak. So next slide, please. So as we know, China have a ongoing develop faster in terms of debt market. If you look at the blue line in the left to the right across the time, you can see overall corporate bond market in China by end of 2018 is more, by outstanding, is more than 20 trillion outstanding into RMBs. And very important amongst all instruments, if you look at decompositions, we can see China have different kind of instrument into the corporate bond. So today, I will emphasize very important component, so-called municipal corporate bond, so-called Chengtou bond, which is issued by local government. And also, we are going to show overall corporate bond market response in terms of COVID-19's pandemics. Next slide, please. So today, I'm going to show you guys overall corporate bond market characteristic. Very importantly, I want to see this kind of regional variations. Okay? Then more importantly, I want to see the rule of government implicit guarantee, especially by times. Okay? Finally, I want to show what's the real effect in terms of through production network. Okay? How COVID-19 pandemics outbreak through the supply chain, to downstream to upstream. Okay? Finally, I think it's very important to talk about policy under evaluate so-called macro policy impact. Okay, next slide, please. So firstly, I just want to highlight, so what's going on in terms of corporate bond yield during outbreaks. The blue lines across the times is bond yields, okay? And right after the pink line is the infection case in China growth rate. You can see more infection rate growth, more pressure to the bond market. You can see yield increase dramatically. Afterwards, a lot of uncertainty in the market. Then you start from Asia, other Asia countries, Europe, then US. You can see corporate bond yields frustrated to index so-called market pressures, uncertainties. Next slide, please. As Sergio just mentioned, it's very important to understand not only issuing. Okay. So far, also follow up. Dr. Shim talk from BIS talk about foreign currency in China. We focus on domestic currency bonds. We also have a very important, also very interesting evidence to show after coronavirus outbreaks, massive increase in February 2020 in the number of the default, corporate default, and the volume of default. If you look at the blue lines, or if you look at a red line, which represented the value or the volume of default, okay, it reached more than 40 billion RMB in total. Okay? Also, into numbers, in the February 2020, China corporate bond default is more than 26 corporate. Okay? So that is a phenomenal event to show not only the yield got pressure to increase, also very important to understand why the Chinese corporate bond started to default during the pandemic outbreaks. Next slide, please. From the next 2 slides, I'm going to show very simple characteristic across the times. I look at pre-coronavirus 19, during the peak and post period. So in the left-hand side, I look at the bond yield by ratings. The right-hand side, I look at the bond yield by maturities. Let's look at the left-hand side first. So what do we look is, if you look at red bars, it's below AAA. The blue bars is above AAA, is AAA. So we can see high quality bond versus low quality bond. So we can see overall, all of below AAA bond, the yield is higher than AAA bond before, pre, and during the peak times. This is for bond yield, is bond yield by ratings. In your right hand side, we'll look at the bond yield by maturities. Red bar represents the bond yields below 5 years, the median in terms of maturities for Chinese corporate bonds, and blue bars above 5 years. Interestingly, there's one very important phenomenon. If you focus on the short-term maturity bond, less than 5 years, you can see during the peak times, the massive increase in terms of bond yields. Nothing changed at all about the long-term maturity bonds. Okay. Next slide, please. One thing we learn a lot this time from China is, I think, a lot of bond market with a Chinese characteristic. Especially, I will emphasize 2 kind of bonds: one by ownership, one by guarantee, implicitly guarantee, so-called Chengtou bond. The local government borrowing municipal corporate bond. Okay, let's start looking at the left-hand side. Left-hand side, the red bar show the private company yield. The blue bar show SOE, state-owned companies, corporate enterprise bonds. You can see significant difference between private versus SOEs. The bond yield pre-crisis and during the peak and post. Okay? So on average, SOE bonds have lower bond yields before pandemics and after pandemic, even the peak times. Okay? It's one hand. Second hand, if you look at bond yield by the local government, so-called the bond, so-called Chengtou bond. Chengtou bond were issued by the local government in China. They have a government implicit guarantee. So if you look at the red bars, those bonds are not Chengtou bonds. The blue bars are bond yields of Chengtou bonds. Significantly different, again, pre-outbreaks, during the peak outbreaks, and the post-outbreak times. Okay, so this is something we want to show in later, the value of government implicit guarantee during bad times. Next slide, please. So as I mentioned, outbreak of coronavirus 19 cross regions differently in China. If we have a snapshot, look at heat map about COVID-19 in China by end of March. If you look at accumulated infected case, the darker in the center was the Hubei province. Okay, so lighter means the less case. So I'm going to look at whether COVID-19 case by regional variations. Okay, I'm going to look at the relationship between bond yields and the case. Next slide, please. So if you want to take away one slide, this is a slide I would like to share, and I think it's very important for World Bank, also international organization. Look at cross-section, cross-country difference. So this chart, I want to see the relationship between the case in the X site, okay, COVID-19 case, across the regions. The red dot represent above medians, the high infection regions. The blue dots represent below the medians in terms of infection case. So the region I want to discuss is the case, infection case, and bond yield. Okay? If you look at the Y side, it's bond yields. There was a positive correlation between the infection case and the bond yields, especially if you look at in the far right-hand side, is Hubei province. More infections, bond on average issued in that province with high yield, which means more pressure to that preference, more difficulty for companies there. Next slide, please. So please go, yes. So due to the time, let me explain to you what's the left and what's the right. So as I mentioned, I really want to understand what's the rule of government implicit guarantees. Look at Chengtou bond, the bond, corporate bond issued by local government. Left-hand panel, I look at all other bonds, exactly the same chart like we showed before, case and yield. Okay? If you are not the Chengtou bond, if you are like not government issued bond, local government issued bond, the relationship still holds. More case, high yield, cross regions. Okay? However, if you look at government bond, okay, Chengtou bond, you have a local government implicit guarantee, there was no relationship. Okay, sometimes even lower in relationship, lower yields. So which means most negative impact to the corporate bond market, okay, through private corporate bonds. Okay, next slide, please. So as I mentioned, we would like to understand the transformation through the production network, through the so-called supply chain, which is the World Bank have a lot of research on this. So let me emphasize 3 lines here. So first, in the middle, which is the major sector industry in Hubei province, issues bond, so the auto, the car industry, and the transportation industry in the middle is bond yield. Okay? In the top is the supplier of auto and the transportation industry. Okay? The bottom, the red line, are the customer of auto and the transportation industry. You can see once the bond yield of auto industry goes up, supplier of auto industry, even in other province, yield increase. Okay? Bottom line, we want to show how coronavirus 19, okay, through supply chain, through production network, transfer to other sector, which is not impact to another province, through the supplier and customers. Mainly, our funding is focused on supplier, which means steel company. You provide some raw material to the car industry. Even you're not in the province, you still got a big hit because you provide it to auto and the transportation industry. Second slide, please. Thank you. Next 2 slides I'm looking at, because in China, due to time, I don't have enough time to emphasize every specific policy. But let me summarize by 2 major policies. As I mentioned, in February 3rd, China opened up early enough of a capital market. Then in coping to all economic policy, firstly, we have a monetary policy. Then we have fiscal policy. Monetary policy, if you look at policy rate, the central bank, PBOC, reduced the lending rate, facility rate. Okay? And also reduced 1-year, 5-year loan premium rate, and reduce reserve requirements. Number 1, interest rate policy. Secondly, lending facilities. They also have a repo operation, re-lending operation, and a lot of credit policy to the market. Okay? Yeah, this is monetary policy. And for fiscal policy, they ask the company postpone to repay and reduce the tax fee and the burdens. And finally, they're more relaxed for bond issuer. Okay? So next slide, please. So this slide, we summarize all effect through monetary policy and fiscal policy. So left-hand side, the red bar shows the effect of monetary policy, and the red bar shows effect of fiscal policy. And we can see monetary policy mitigate the bad shocks, roughly 0.3%. Fiscal policy, the same effect, also reduce or mitigate the bad shocks of COVID-19, around 0.2%. Okay? The next slide, please. Let me summarize. So today, I would like to, I'm very glad to present this ongoing research with QJ and Dora and Yaya, which try to understand how Chinese corporate bond market responds to the COVID-19 outbreaks. We do find out the bond market response, the pricing is a risk. Okay? And the yield increase, especially for lower credit ratings, short maturities, less government support sectors. Also regional variation about higher infection case and the more increase in terms of bond yields concentrate on those bonds are not government guaranteed, local government guaranteed central bonds, or private bonds. Okay? And this suggests the rule of government increased guarantee during bad times. Thirdly, we look at how corporate bond market responds the bad shock COVID-19 through production network. The supplier of the most infected province, most infected sector in Hubei province cost sectors. You can see supplier of that sector got hit as well through supply chain. Finally, we do find out government policy matters through monetary policy and fiscal policy. Thank you very much.
Alfonso, I think you're on mute.
Okay. So I was thanking you, Ji-Huan, for the presentation. Thank you. It was very interesting and very detailed, and I'm sure that there will be questions. But let's move quickly to Joseph Cherian, the last presentation of this webinar, and then we will open the floor for a Q&A. Thank you, Joseph. The floor is yours.
Thank you, Alfonso, and the World Bank team for inviting me. My presentation is just an extension of what has been discussed so far, except most of the discussion so far have been on the credit channels. There was one mention of equity participation, I think by Sergio. So let me talk a little bit from our side. It applies in any context, but I'll use Singapore as a case study since I'm most familiar with the Singapore context. I read the papers every day. I have the data for Singapore. So I'm just sharing the Singapore context, but it applies in any context. It can be any developing or emerging economy. Now I'm going to move on, but I can't seem to move the slides. Oh, here we go. So first of all, let me just quickly show you that the context in Asia is no different from the US. These are just the industrial performance, industry returns performance for SPX, S&P 500. The winners and losers are usual suspects. We have tech, telecom, healthcare, pharma, the winners on the US side, and the losers being automobiles, as mentioned in China as well. You see the automobile sector being affected, same in S&P 500, hotels, airlines, and so on. The companies are a bit hard to read, the winners and the losers. I printed this up here, but basically, let me just read it off because it's even hard for me to read. Regeneron, which has been developing the antibody treatment, Citrix, which is actually hosting this presentation, Netflix, Clorox, the disinfectant company, Amazon, Gilead, and so on. On the loser side, it's companies like oil companies, Carnival Cruises, United Airlines, and so on. So I just want to show you very quickly on the Asian side. This is the MSCI, all countries Asia, ex-Japan. It's done at the sector level, so you don't see as refined a breakdown on the performance. If you look at the winners and losers, let me read that out to you because it's a bit tiny. We have Alibaba Healthcare, Ping An Healthcare, Heilongjiang Agriculture, I may not be saying this right, and a few other healthcare companies as winners. And on the loser side, we have Tata Motors, Air Asia Group, and so on. So basically, it's a very similar experience here. It's a heterogeneous, as I think Sergio pointed out earlier, it's heterogeneous in the industry effect. Some are winners, some are losers, but mostly, especially in Asia, they're losers than winners. So what can we do? So basically the cavalry here is the government. We know from our economics 101, when there's condition of market incompleteness, that is, there's not sufficient arrow-deburrow securities to span the sort of bad states of nature that are taking place. There's lack of spanning. What happens is you have a condition of market breakdowns or incompleteness. You need some form of entity like the sovereign stepping in to provide the sort of completing the market, so to speak. And that's what's been happening. Many countries, as we saw in the previous speakers' presentations, Singapore has been doing that on multiple fronts, on the household sector, business sector, and the self-employed. So as was mentioned earlier, on the business front, mitigating job market disruptions was critical for the Singapore government. That was top of the priority. So they have actually been subsidizing wages. In some industries, up to 75% of wages, up to a cap. There have been various forbearance programs, rental relief, contractual obligation, which is very interesting. I don't know how many countries have practiced it, but instead of a company declaring force majeure, they basically, the government came up with an act to sort of temporarily hibernate all these contractual obligations until the pandemic is over. And of course, there's also property and corporate income tax and the credit channel. Singapore introduced ultra low interest bridge loans. The MAS, which is the central bank, channeled it through the banks at 0.1% interest, which is very, very low. And then the banks have to do the picking and choosing which SMEs or the small and medium enterprises would receive those loans, what quantum and what interest rate at. It's not at 0.1%, of course. Moving to the next slide. Oh, here we go. So let me do a case study of a very simple Singapore case. Basically, what I have is I've taken the F&B industry, which has been most affected in this pandemic here, especially in Singapore. It's a pretty substantial, a $10 billion industry. And basically what has happened is, this is the pie chart shows you, I just got it off the website of the Food Industry Association. This is a rough breakdown of the average F&B companies' cost structure. Manpower is the biggest part of it. Rent, food, and food costs are those expenses that show up here at different percentages. And 14% is for utility, leases, machinery, maintenance, and so on. For this particular average company, there's a profit of 15%. But I thought I'd just do a simple case study of why these companies need to be helped out. These are companies that do not have access to capital markets in the traditional context, so they're not listed. These are basically mom and pop shops and companies that are very small in size. So let's say this company is at a break even, this restaurant is at a break even, having sales before the pandemic started about 1 million per annum. So if you do the rescale, the renormalized breakdown of this chart, this pie chart, that will work out to, just mark my words that I've actually done the calculations, food cost of 305,000, rent at 200,000, manpower at 329,000, and the other costs at 164K. And it's break even, so no profits. Let's just take this as a simple example. During the pandemic, I read in the media that this restaurants on average saw 20% drop, 80% drop in sales, and they can only do it through takeout and delivery, no dine-in. That's the rules right now in Singapore under the circuit breaker system. So let's say 20%, that's 200,000. Food cost is about the percentage, 61,000. Rent, the government subsidizes 1/4 of it. I'm again taking it from media accounts, 1/4 of it through rental subsidies and rebates and property taxes. So the company, the food and beverage restaurant is still on the hook for 150,000. Manpower, let's say the government subsidizes 50% of the wage, which is what the case is in the food industry. So 164,000 comes from the company and 164 from the government. And the other costs, let's say utilities can be cut down, some expenses cannot be cut. So that 60% is $98,000. So it's still on the hook in the hole for 275K. And that's the problem these companies are facing. And as I think, again, Sergio used the word hibernation. You can't freeze the company. You need to hibernate it and let it operate at 20% capacity. How do they continue? I took from Sergio's slide that restaurants usually have 30 days of cash on hand. And when you look at it, Singapore has about $10 billion in the food sector, in these restaurant sector. Back of the envelope calculation says there are about 2.7 billion in F&B financing needed just for this one tiny sector of the economy. So let me go to the next slide. It's a bit slow in controlling. Let me see. It's not moving anymore. Here we go. So here's the idea that we came up with. Anyway, let it all show up. So SMEs, that's including the food sector and all the other companies, the car, automobile repair shops, showrooms, and so on, are 45% of value add, which is about 45% of a $507 billion economy. It provides 72% of 3.5 million jobs, and it's 99% of all enterprises. They don't have access to capital markets. So and you can see the slide saying virus battered smaller business, flood banks with loan applications. This is from the local newspapers. So obviously there's a problem getting access. There's credit channels available. As I said, the government has stepped in and very efficiently and quickly provided these loans, but there's still some frictions. Maybe recently it has improved, but at least up to the data I looked at April 23rd, it has not been disbursing much. What we propose is a pseudo-equity financing structure for these SMEs, along with the loan scheme, the subsidized loan scheme. It's not new. It's been practiced before in the US during the 2008 crisis. Recently, it just was brought to my attention that two people at Brookings Institute proposed it for large listed US companies like airline companies and oil companies. This was in Fortune, so that came out a few days later. As I said, in April 20th, they improved at the MAS and a state board agency called Enterprise Singapore, improved the terms they can borrow at these SMEs at 0.1% over 2 years. Yet, it has not disbursed as much. Again, as I said, I don't have the latest data, but it has only disbursed about 500 million out of the 5 billion, I think, that's available. And then I read on April 29th in Bloomberg, the US the administration is thinking of unveiling bridge loans for ailing oil companies along with financial stakes. I'm not sure if they are implementing that yet or not, but that's what I read. So here's how our system will work. So we already have on the left-hand side, the enhanced enterprise financing scheme, which is offered at 0.1% lending rate. There's a credit enhancement component. These are things that all of you have been mentioning earlier. So there is a credit enhancement component. There's a 90% risk share by the government, 10% risk share by the bank, the local banks that will lend out. The final interest rate charged by the bank to the SME is determined by the cost of funds and the risk profile and so on. But don't forget the 90% risk share obviously brings the borrowing rate down a lot for the SMEs. Prior to the pandemic, lending was going on to these SMEs at about 8 to 9%. Apparently, banks are claiming in the media that the rates are now down to 2 and 3%. But anecdotally, I'm still hearing some SMEs have difficulty accessing these funds. Anyway, coming to this proposal on the right-hand side, it's conjoining the enhanced financing system with the equity system. How you implement it, what vehicle structure, that's up to you, up to the government. So basically you use some kind of quantitative filters so that you do not have totally zombie firms pre-pandemic and post-pandemic. They will continue to be zombie firms. I don't think you want to rescue everyone, but you want to rescue a large fraction of companies that could potentially survive. So use some kind of quantitative filters. You could perhaps use the bank's credit loan officers who are giving out loans on the left-hand side, use them as well to do some of the financing decisions, making the financing decisions. But the key goal is to increase the quantum of financing available to the SME and to bring down the borrowing rate on the left-hand side. So that's a key goal here, quantum and bringing down the interest rates. How do the SMEs pay back the financial stake that the government takes into their company through this equity financing? Probably through higher corporate taxes or whatever. It's some form of dividend. And then you give the SME the option to buy back the buy back from the SPV their stake that the SPV has at a future date when things are normalized and everyone does well. So this is not new. In 2008, as you all know, the Fed issued a loan to AIG in exchange for about 80% of the company's equity. So this is a conjoined solution. So option one, the SME needs 1 million in financing. It could do it either through the traditional structure, or it can do 50-50 or 75-25 using the loan and the equity structure. So I've given you all the details here. And basically, in the interest of time, I think I have a couple more minutes. I'm not going to go into all the details. I'll make the slides available to whoever wants it. But basically, the way it works is because you're reducing, there's some amount of risk sharing that's taking place in the transfer of risk, partly being transferred over to the government. It should bring about lower risk exposure to the banks, so bring down the interest rate in a commensurate manner. And secondly, the quantum can increase because right now there's more capital on the balance sheet of the bank to actually lend out. So I hope this method will achieve both goals. Again, I use a Singapore example. It's not been implemented here, but it can be implemented in any country. I know that our neighboring country, Malaysia, has these kinds of SME subsidized loans being offered by Bank Negara as well. I've read about that. So it can be used in combination in this context. And the happy note of it is, again, the goal is not to make money for the government, just to get paid back. But in the case of AIG, as we know, when the government cut its stake to 21.5%, about 4 years later, it made a profit of about 12.4 billion. Again, that should not be the objective here, but it's a nice positive externality that comes from this exercise. So I won't go over the next slide, which talks about the risk management, because earlier we talked about moral hazard, adverse selection. One thing I can say is Singapore is a small country. It's well managed, and there are a lot of state agencies that are here to help the SMEs. So it's a little bit more easier to manage. I think in other emerging countries, it may be a bit more tricky because the reputational and other effects may not be as pronounced. So they need to think carefully about how to reduce those kinds of risk, adverse selection, moral hazard, and so on. But again, it has to be done on a country-by-country basis. With that, let me hand it back over to Alfonso. Thank you. Alfonso, you're on mute.
Thank you for letting me know. Every time I try to speak, I'm on mute. Probably it's quite late here in Washington. Thank you, Joseph, for the presentation. It's always great to see what Singapore is doing. Always a good example for others. So in many cases, very difficult to replicate in other countries. But I think, I mean, we don't have many questions yet, so I will wait a little bit more to hear more from the audience. There is one question, actually, from our colleague Mark McKinsey, which he's asking how critical it is to consider moral hazard, given that we are dealing with Taleb's fourth quadrant problem, extreme black swan, and what should be considered to avert moral hazard. This question is, I think, more directed to Sergio, because he was mentioning and talking about moral hazard and how it was needed to avoid any moral hazard in the policy measures that we take. So maybe you can take it, Sergio, while we wait for other questions. But I mean, if you also would like to react to others' presentation, please go ahead. We have 10 minutes for the Q&A, which I guess would be at least to open a little bit the appetite for more to come. Thank you. Sergio.
Thank you very much, Mark, for the question. regarding moral hazard. I think this is something that comes up in the discussion whether governments should try to provide assistance to all or try to minimize moral hazard. And there are different views. I think that of course, the priority is now to kind of save firms so they continue operating. Now, if we think that resources are limited, we might want to provide financing to not everybody and to some of them, we could use the principle of trying to avoid moral hazard. One possibility is with respect to reducing moral hazard ex ante to firms that were not doing well before. You might want to say, well, I'm going to provide financing, given the financing is limited. I'm going to be giving financing to the firms that were in good performance before the pandemic. Firms that were in the process of being liquidated, just throwing more money to them, given that they were in bad shape before, it might not be worth spending the resources there. So you can take the credit ratings, let's say before the credit scores before the pandemic. If they were doing badly and the process of being shut down, it might not be worth putting extra resources. With respect to ex post moral hazard, I think that's also important in the following sense, and this is something related to what Joe was mentioning. We are going to be throwing money into firms, public money. We are blowing up the balance sheet of the government. This is debt that the government will have to pay later on. The idea Joe mentioned is not to make money here, but to the extent that the money can recuperate some of the investment because of this shock, and at the same time kind of reduce the debt that the government is taking, because the debt is going to increase no matter what. But to the extent that we can limit that, I think that's kind of important, because otherwise you might give incentives to firms. Some firms might be able to shut down and use the money to open another business. Let's say that you are providing money to a restaurant that with no strings attached, then the restaurant owner might say, okay, I use the money, I pay myself, I close this restaurant, I open a similar restaurant next door, a very different name, but basically the same food, and just taking the money for free from the government. So I think that those type of incentives are the kind of schemes that might end up costing the government much more. So to the extent that you can prevent them with kind of working with banks and having banks have skin in the game or creating some incentives, so the cost is not so large, I think in that sense it helps. But I agree that the priority now is saving firms. So these kind of things to take into account, how to save firms and how to reduce costs going forward.
Thank you, Sergio. Actually, I have one question for Joseph, or whoever wants to jump in as well. It is related to the story that you were telling, Joseph, which is in a way for the state to enter into the equity of some of the firms when providing this support. There was actually also an article in the Financial Times this weekend precisely with the same idea, no? And there are many countries in the world that are doing this type of or are taking this type of decisions, no? Which was something that I also mentioned at the beginning. No? If you really want to go and provide lots of support, to what extent shouldn't the government use equity to do that? But we also know that this can create a significant, or not, but at least will lead to a very different situation with a significant increase in the presence of the state, no, in the private sector. So is it a concern? Is something that we should be concerned about, because the landscape will change significantly if countries continue or start doing this type of support?
Okay, maybe I'll take that since you mentioned my name, Alfonso. Can you hear me?
Mm-hmm.
Okay.
Yep.
So as I said earlier, the first best solution is what all have been proposing, the credit channels. First, capital markets, or if not, credit channels through banks, with the central bank either providing some kind of guarantee, stop loss, credit enhancement. That should be the first channel. Use the credit markets for that purpose. The problem we are hearing, and it's not just in Singapore, it's many countries, is that there's still not enough of it going out because banks are still a bit, how shall I say, on the loan side at least, a little bit reluctant to lend as freely as we would like them to. Probably there's some kind of risk aversion or loss aversion or whatever there is that comes with it. Similar with capital markets. Until the Fed stepped in and started buying out junk bonds, Boeing couldn't even access the capital markets at favorable rates, as we know from the news articles. So that said, equity participation is what I call the second best solution. It should be done in tandem with credit channels, and it hopefully should achieve the goal of reducing the credit spread, as well as increasing the quantum. So to me, it is sort of, it cannot be offered unilaterally. It's something that's pegged on or superimposed onto the credit solution, just to make more credit available, because as all the previous speakers said, this is a health crisis that's led to the financial crisis, not the other way around. So you need some pretty out-of-the-box thinking to provide enough financing to allow these companies to hibernate until things get back to normal. And that's my way of thinking about it.
Thank you, Joseph. Any other reaction?
Alfonso, one thing that is there in the questions that's coming from one of the colleagues that I also had in my mind is this idea of equity kind of financing, whether it can apply to all firms, because usually when you go to smaller firms, it's much more difficult. So it's easy to do with large corporations, with AIG or with GM or Fannie Mae or Freddie Mac, but then you start going down, and then it becomes extremely difficult.
Can I maybe share the Singapore experience since it's on equity? So in most of these countries, I know they have it in our neighboring region, in the ASEAN region as well, we have statutory bodies or government agencies that look after the SME sector. These are the ones who don't have access to capital markets, they're not listed. And then you also have the banks which have been traditionally lending to these SMEs. So the way to get around that, to reduce all the moral hazard and all these other issues, other problems, is to get them together with the agency that's doing the funding or the SPV that's doing the funding to do some kind of screening. But again, the screening shouldn't be at the level of a venture capital firm, which is too strict and too loan shark-like. I apologize for using that word, but it's too vulture-like. It needs to be a bit more benevolent. We do not want to rescue zombie companies pre-pandemic and post-pandemic, but we want to rescue those who have a chance to recover to use your words, Sergio, the hibernation period. So I would suggest that it's a private-public partnership. The banks, loan officers, with the stat boards that look after the SMEs, and the government being involved, whether it's a federal government or whatever, being involved jointly in making those decisions. But make it as quantitative as possible, so that no one can accuse you of pork barrel type politics or any kind of favoritism on the political side, that you favor some industries over the other. Make it as quantitative as possible. That's my recommendation. I have a question. Can I ask a question of Ilhyock? Is it possible, or do you want to go? Yeah, Ilhyock, I have a question.
We have 1 more minute.
1 more minute. About your outflows of the assets under management in emerging economies. I'm just wondering, as a cushion to prevent outflows, and I think I saw it in one of your slides, if you look at the institutional ownership structure of the local currency bonds or local equities, what if you have a strong state-owned state fund, state sovereign wealth fund, or strong pension system of local pensions, mandatory pensions, or strong insurance industry? Does that make a difference to the rate at which this money flows out? Does it form a sort of natural barrier without the government having to step in, or the central bank having to step in, providing liquidity mechanisms to support these funds? Have you seen that in the data? local institutional ownership structure preventing local currency funds from having massive outflows? I thought I saw it in one of your charts, but I could be mistaken.
Yes, thank you, Joseph, for your question. Can you hear me?
Yes, yes.
Yes.
So, yes, in general, that's correct. If you have a strong institutional investor base locally, that's really going to help. Although there is a big caveat. So you can call insurance company pensions locally organized, which has no currency risk exposure, then they are more likely to buy. But they also have other constraints, like rating constraints and so on, and they may have not enough resource. So I guess a lot of constraints actually in reality, and you may not be able to convince them to buy to the extent that you actually bring the yields down, which is basically what QE wants to do. Right? The central bank quite often directly go in the market with a specific objective, which is quite different from sort of asking private sector institutional investors. So there is a difference between the two groups of investors. Purely government/central bank versus institutional. But in general, if you have a strong local investor base, which can step in and point of sale, that actually helps. That's in a sense the idea of this bond market stabilization funds, or even equity market stabilization funds, which has been introduced recently in many countries.
Thank you.
Very good. Thank you very much, colleagues. Thank you very much, speakers. It has been very, very fruitful and very thoughtful webinar, in my opinion. I would like to. We are already over the time, so we need to close the event. I really would like to thank the speakers, Ilhyock, Joseph, G, Sergio, for great presentations. To thank all of you for attending this webinar, and of course to thank the World Bank Group Knowledge and Research Hub in Malaysia and Reka Reddy for organizing this great event, and thank you for inviting me to provide the opening remarks and to moderate it. Have a very good day in East Asia. Have a very good night in Washington, and thank you very much for attending. Thank you.
Thank you
Very much.